Welcome back. You're watching Taking Stock, and this really was a historic week that we're taking stock of. The market hit all-time highs with very high volumes. Sandeep Shah, Motilal Oswal now joins in. Sandeep, hi. Good to have you on the show. Did you expect the market to reclaim the highs after the kind of 5% correction we had in a matter of, 10 or 11 trading sessions?
Well, actually, I had a target of about 76 to 7,800, and interestingly, the market rebounded from 77.20 on Friday, and immediately after that, the news flow everywhere all around us seems to have turned positive. We got news of a stronger political mandate for Mr. Modi. We've started seeing bits and pieces of reform coming in. We've had good quarterly numbers this week compared to the previous week, where we had more disappointments. And globally also, the economic data has actually suddenly turned positive. So a rally was expected, but obviously I think the momentum of this rally has certainly been sharp over the last few days. So to that extent, yes, the momentum has been swift and sharp. And the chances are that, I think that it's of course still a relatively young bull market. But given that the market has gone up for about 8-9 days on a trot, I think some call for consolidation is possible going forward from here.
Okay, Sandeep, hi. Thanks for being with us. What are your top stock calls now post-earnings season? What have you liked this time around?
Well, I think, we still have some time before close of earnings season. But yes, there has been a fair amount of companies which have done well, including private banks, NBFCs. If you were to look for top picks, I mean, clearly, the private banks, Industrial and HDFC Bank continue to do exceptionally well. Yes Bank has pulled in now. I think a lot of banks like Yes Bank and perhaps Kotak could also fit into that category, had actually deliberately slowed down on credit growth because of the economic environment. And as hopes build up of an economic recovery, you would see credit growth also coming back there. Besides that, of course, there have been a host of other companies as well. Sort of the NBFCs have reported good numbers. A smaller company there, Diwan Housing, has also done pretty well. That's again a company which has got incredibly low NPAs, is trading at less than book next year and has ROE of more than 18%. There's a lot of other ideas as well across sectors, but I think the theme for the market broadly remains focused on growth. It remains focused on quality. And as yet, actually, there is little incentive to change that investment approach.
Okay, that's interesting. Sandeep, in terms of the two large sectors, this month was all about banks. You had the Bank Nifty outperforming 10.5%, but from the bottom, IT also made a very strong comeback. At one point, IT index was down 6%, but it ended flat for the month. Going forward, what would be a better pick, frontline IT or frontline banks?
Oh, absolutely, frontline banks. No question about that. This is not to say that I don't like IT and I don't think IT stocks will do well. They will. However, I think in spite of the fact that the private sector banks, especially the larger ones, have done well. They've done well, in an economic environment which has not been good. And a better economic environment can add that much more to growth. It can mean that, even if we see some of the good banks reporting numbers, we've seen some sequential increase in gross NPAs. In some cases in absolute terms, in some cases in percentage terms, the increase hasn't been dramatic. But at the same point of time, we're still seeing that. So, there's a lot of that which could reverse, and you could actually also see gains as you find that not just the rate of addition to gross NPAs actually comes off and starts falling, but you actually start seeing recoveries as well. IT companies will also do well. I think valuations are, for some of them, are quite reasonable. Some of them, like Tech Mahindra, continue to do exceptionally well and continue to be some of the stocks we like. I think one of the reasons why tech stocks corrected was because because the market was disappointed with TCS numbers, but then I think that's partly because expectations had also run up significantly. So IT stocks will do well, but I don't expect them to dramatically outperform the benchmark, unlike banks, which I think could significantly outperform from here as well.
Okay. The stock that has been the biggest gainer in the month of October, Sandeep, was interestingly BHEL with almost a 30% gain. And that's peculiar because it was not corroborated by either good earnings or any fundamentally positive news. Would you buy BHEL now?
Well, the first thing is that when you find stocks which have corrected 50, 80, 90% from the peak, you will continuously and ongoingly see rallies of 30 to 50%. Because that will only retrace a very small proportion of the fall, because the 30% is on a base which is 50 or 80% lower. So that's one part of the story. Secondly, I think that BHEL did win a few orders, and I think that gave some sort of confidence to the market. Having said that, capital goods and power as a sector is something that still needs more action at the ground level. I think the government is doing their bit and will continue to do so, but obviously it's a sector where it takes time, it takes 9-12 months before the efforts to actually speeden up projects, clearances, etc. starts reflecting into financial closure, starts reflecting into order flows, starts reflecting in terms of actual delivery and sales and profit numbers. So there's a huge cycle out there. So having said that, I would prefer to stay invested with the proven quality names. Not that BHEL isn't good quality, but in terms of growth, I think there are still a fair amount of questions. I would happily stay invested in an L&T, and which has also corrected, and where also numbers haven't been as per market expectations. So in a relative sense, I think there's probably more of an opportunity in L&T, whereas the risk is probably still higher in BHEL.
Okay, that's interesting, Sandeep, because my next question was a bit related. The last half of September and first half of October saw quite a bit of underperformance from high beta. But now with the market back to all-time highs and easy liquidity again back in the system, would you be tempted to bring some beta into portfolio, some slightly lower quality stocks which could be high risk, high return bets? Would there be temptation to include some of these stocks in portfolio? The likes of NCC, GVK, HCC, which had good run on Friday as well. Would you consider looking at them?
Well, the first thing that I would say to that is that, buying stocks like GVK, GMR, and I mean no offense to the promoters, and I think, I'm actually referring to the space in which they operate in and the leverage that they have on their balance sheets, as well as the environment in which they're currently operating, I think can at best be looked as an option value. I think that's the best way that you can look at it. You can probably, and I'm not recommending it, I'm simply saying that for somebody who would like to invest in those companies, and that's not a recommendation from me, the only way that you can look at investment in highly leveraged companies in sectors which are actually still in the doldrums is to actually buy them as an option value, and to say that this is the percentage of my capital that I'm willing to write off, and therefore that's the kind of position that I can take. As far as I'm personally concerned, I would actually prefer to stay in quality. If I have to look at beaten down sectors, I would look to buy quality within those beaten down sectors, as opposed to buying companies with high financial leverage in those sectors, and therefore and proven leaders. Because when you're buying a beaten down sector, you're obviously taking high risk. So how do you offset or mitigate that risk? How do you ensure that even if things don't work out, your capital is still preserved and you still get some returns? You do that by buying the best companies in the space. You do that by buying companies which have got low leverage on their balance sheets, which have got good quality management, and leadership in their respective sectors. I think that to my mind would be the smarter way to play it, rather than take a whole lot of risk at this stage.
All right, on that note, we'll let you go. Thanks, Sandeep, for joining us, and we'll keep in mind the stocks that you gave our viewers, and let's see how they go from here. It's been a great week for our markets, a great month as well. On that note, from Anuj, myself, and everyone else here at CNBC TV 18, thanks for tuning in. We'll see you again on Monday.